Pause whatever you're doing immediately, because within the next 6 hours, a financial market event is set to unfold that has the power to either generate enormous wealth for you or leave your holdings completely vulnerable. I am not overstating the situation when I tell you the indicators I'm currently analyzing are displaying formations we haven't witnessed since the 2008 crisis. The countdown is actively underway, and if you delay taking action until tomorrow morning, you will have missed the critical window. Over the past 72 hours, I have immersed myself in trading data, institutional activity, and the discrete maneuvers of major financial entities. My discoveries are nothing short of astonishing. Please stay with me for the next several minutes as I will detail precisely what is occurring, the reasons it's unfolding now, and most crucially, the specific steps you must take within the coming hours to safeguard your interests. Before we delve into this analysis, I urgently need you to click the like button at this very moment. I am completely serious. Do it now. This intelligence must circulate to the maximum number of individuals before this opportunity vanishes. Furthermore, if you have not yet subscribed to Let Finance, what is holding you back? Our channel stands among the very few delivering consequential real-time market alerts that truly make a difference. Tap that subscribe button and enable notifications, because the developments over the next 48 to 72 hours are going to be extraordinary, and you will want immediate alerts when we publish our next update. All right, allow me to explain the current situation and why the coming 6 to 12 hours are of paramount importance. Throughout the past week, I have observed highly anomalous activity in the overnight futures markets. The majority of investors pay no attention to the period between midnight and 6 a.m. Eastern Time, yet this is precisely when large institutional entities execute their most significant maneuvers. They operate while retail traders are asleep, when trading volume is thin, and when they can shift prices without attracting attention. I have been monitoring this space, and the developments are deeply alarming. Beginning last Wednesday, there has been an enormous surge in the purchase of put options on major market indices. For those unfamiliar, put options are essentially wagers that the market will decline. We are not discussing small-scale retail traders buying a handful of contracts. This is institutional capital, the kind of money that possesses insider knowledge and understands developments the public does not. The trading volume on these put options has skyrocketed by 340% in just 5 days. Contemplate that for a moment. Entities with substantial resources are placing heavy bets on an imminent market downturn, and they are doing so discreetly. However, the plot thickens further. Concurrent with this surge in put buying, we are observing major institutional investors quietly liquidating their holdings in specific sectors. I am referring to technology stocks, consumer discretionary names, and financial institutions. These are the very sectors that have propped up the market for the last half year. Now, why would sophisticated capital be exiting these positions at this moment? Why would they conduct this exit so silently that the majority of the market remains unaware? The answer is straightforward. They are aware of an impending event and are positioning themselves accordingly. Let me now connect several data points for you, as this is where the situation becomes critically important. Yesterday afternoon, the Federal Reserve released the minutes from its most recent policy meeting. Most individuals glanced at the headlines and moved on, but if you perform a deep dive into those minutes, you will find deeply concerning language. The Fed discusses an unexpected deterioration in specific economic indicators. They deliberate on the potential need for emergency measures should conditions worsen. This is not the terminology used when everything is stable. This is the language that appears immediately before a breaking point. This concern is not isolated to the Fed. Examining the global landscape, central banks worldwide are beginning to exhibit panic. The Bank of Japan issued an unexpected announcement 2 days ago. The European Central Bank has convened an emergency meeting for this Friday. The Reserve Bank of Australia just enacted a shocking policy shift that no analyst predicted. When central banks initiate sudden moves of this nature, it is because they are witnessing terrifying data trends. They do not call emergency meetings because conditions are favorable. They do so because they must act swiftly to avert a crisis. Here's a concept most people fail to grasp. The markets we observe during regular trading hours are not where the decisive action occurs. The real moves happen in the overnight futures markets, within the currency markets during Asian trading sessions, and in the bond markets, areas most retail investors never examine. Presently, all three of these arenas are flashing unmistakable warning signals. Treasury yields are moving in patterns that defy logical explanation, unless you recognize that smart money is fleeing toward safety. The US dollar index is exhibiting extreme volatility, typically reserved for the immediate precursor to a major market event. Commodity futures are pricing in scenarios that would stun the general public if they comprehended the implications. Allow me to provide a concrete example. Gold futures are currently trading at a premium to physical spot prices not seen in over a decade. This signifies that traders are willing to pay more for the promise of future gold delivery than for physical gold available today. Why would this occur? Because they anticipate that obtaining physical gold will become substantially more difficult very soon. They expect demand to surge and supply to tighten. This dynamic only materializes when panic emerges regarding the stability of the entire financial system. Silver is displaying even more extreme behavior. The disparity between the paper price for silver on the COMEX futures exchange and the price for physical silver in Shanghai is the widest in recorded history. We are discussing a divergence of $30 per ounce. This is irrational. It indicates that the paper markets and the physical markets have entirely decoupled. When this occurs, it often happens immediately before one of those markets suffers a complete breakdown. This brings us to the critical 6 to 12 hour timeline. Please pay extremely close attention. Tonight at 8 p.m. Eastern Time, the Asian markets will commence trading. Based on the pre-market indicators I am monitoring, we could witness substantial moves the instant these markets go live. Nikkei futures are already down 2.7%. Hong Kong futures are displaying even more severe declines. If these markets open and immediately commence a heavy sell-off, it will create a cascade effect that will impact European markets upon their opening hours later and then slam into U.S. markets tomorrow morning. However, here is the crucial point. You currently have a window of opportunity before those Asian markets open to position yourself. You have perhaps 6, maybe 12 hours at most before this information becomes obvious to everyone and the opportunity evaporates. This is your chance to be ahead of the trend instead of reacting after the damage is done. This is your chance to be on the correct side of the coming events rather than being blindsided like 99% of investors will be. So what practical steps should you take with this information? First, you must honestly assess your own portfolio and your personal risk tolerance. I cannot provide personalized financial advice, but I can report what the sophisticated money is doing at this moment. They are reducing exposure to overvalued technology stocks. They are exiting any position that is highly leveraged or dependent on cheap credit. They are moving into assets that historically perform well during periods of economic uncertainty. They are purchasing insurance in the form of put options or inverse ETFs. Most importantly, they are maintaining significant cash reserves to acquire assets when they go on sale. If you are holding stocks that have appreciated dramatically over the past year, you should seriously contemplate taking some profits before tomorrow's market open. I am not advocating panic selling everything. I am recommending intelligent assessment and acknowledging that markets cannot rise indefinitely. When you observe institutional capital quietly exiting, it may be prudent to at least reduce your exposure. You can always re-enter positions later if my analysis proves incorrect, but if I am correct, you will be profoundly grateful you secured those gains. For those with a more aggressive stance who understand options trading, this could represent an opportunity for significant returns in a very short period. When volatility spikes, as I anticipate it will over the coming days, option premiums can skyrocket. A well-timed put option purchased within the next few hours could potentially yield returns of 500% or even 1,000% if this scenario unfolds as the data suggests. But I reiterate, options carry substantial risk. You must understand the mechanics. Never risk capital you cannot afford to lose. Now, let's discuss precious metals for a moment, as this is exceptionally important. If you have watched Let Finance for any period, you know we frequently discuss gold and silver as safe haven assets. Currently, we are witnessing truly remarkable activity in the metals markets. Physical demand is absolutely soaring, while paper prices are being artificially suppressed. This creates a rare opportunity. When you can acquire physical metal at prices that do not reflect genuine supply and demand, that is precisely when fortunes are built. The complication is this: if what I expect occurs over the next 6 to 12 hours, you may not be able to obtain physical metal at these prices for much longer. Dealers are already reporting delivery delays. Premiums above the spot price are beginning to climb. If we witness a panic-driven rush into safe havens when Asian markets open tonight, you could awaken tomorrow to find premiums have doubled or that physical metal is simply unavailable at any price. I have seen this pattern before. During the 2008 crisis and the March 2020 panic, when fear grips the market, everyone stampedes towards safety simultaneously. There is simply not enough physical metal to satisfy that demand. Here's another critical insight. The large institutions, central banks, and sovereign wealth funds are not buying paper contracts. They are taking physical delivery. China has been accumulating gold at a record pace. Russia has been doing the same. Globally, central banks have been net buyers of gold for 15 consecutive quarters. They possess knowledge. They are preparing for an event, and they are doing it quietly while suppressing the paper price to accumulate more before the public realizes what is happening. Let me share something that may sound incredible, but I assure you it is true. Reports are already emerging from certain bullion dealers indicating they have been instructed to expect allocation limits to begin as soon as this weekend. This means that even if you have the funds and wish to purchase physical metal, you may be restricted in the quantity you can actually acquire. Why would dealers implement limits unless they are anticipating a massive demand surge they cannot fulfill? This is the type of activity that occurs immediately before a crisis, not after it has begun. Now, I want to address a factor most people completely ignore: the currency markets. Presently, we are seeing highly unusual movements in currency pairs that typically only manifest during periods of extreme stress. The Japanese yen has strengthened considerably against the US dollar over the past 48 hours. This is a classic flight to safety maneuver. The Swiss franc is exhibiting similar behavior. These are the currencies investors flock to when they become frightened about the global economic outlook. This is not a minor shift. We are observing moves that would normally unfold over weeks or months compressed into mere days. Simultaneously, emerging market currencies are being decimated. The Brazilian real is declining. The Turkish lira is in free fall. The South African rand is displaying severe weakness. This is the exact pattern observed right before a major deleveraging event. And when conditions deteriorate, capital flees risky emerging markets and floods back into safe haven currencies of developed nations. The fact this is happening concurrently with all the other warning signals is not a coincidence. Then there is the bond market, arguably the most critical market that receives the least public attention. Right now, the yield curve is behaving in a manner that has accurately predicted every single recession over the past 50 years. I will not burden you with excessive technical detail, but understand this: when specific segments of the yield curve invert as they are inverting now, economic turmoil typically follows within 6 to 12 months. We are currently within that historical window. We are at the precise point where economic pain traditionally begins to manifest in the real economy. Corporate bond spreads are widening. This means companies must pay higher interest rates to borrow money compared to government bonds. This only occurs when investors grow anxious about corporate defaults. If you examine which sectors are experiencing the most significant spread widening, it is precisely the sectors you would expect: highly leveraged firms and zombie companies that have survived for years solely on cheap credit. These are the enterprises that will face serious jeopardy if we encounter any form of credit crunch or economic slowdown. Here is what I anticipate over the next 6 to 12 hours. If my analysis is accurate, Asian markets will open under significant selling pressure. We will witness futures markets gap down at the open. By the time European markets commence trading, the selling will accelerate. When U.S. markets open tomorrow morning, we could experience one of those trading sessions where the market opens substantially lower and continues to decline throughout the day. I am discussing a potential single session drop of 2% to 3%, possibly worse if genuine panic takes hold. If this transpires, closely observe the precious metals market. You will initially see paper prices drop as traders sell all assets to raise cash and meet margin calls. You will see premiums explode higher. You will see dealer inventories deplete. You will see individuals willing to pay any price to secure physical metal. This is the pattern that has unfolded during every prior market crisis. There is no reason to believe this instance will be different. The key is to recognize that you have a very narrow window right now to act before the panic commences. You can still acquire physical metal at relatively normal premiums. You can still exit overvalued positions at reasonable prices. You can still position yourself strategically before the broader market comprehends the situation. But that window is closing rapidly. Once Asian markets open and if they sell off aggressively, the entire dynamic changes. Suddenly, everyone is scrambling and you are competing with millions of other individuals attempting to execute the same trades. I need to be perfectly clear on one point. I could be mistaken about the precise timing. Perhaps this does not occur tonight or tomorrow. Perhaps the scenario requires another week or month to fully materialize. However, I am not mistaken about the overall direction. The data is undeniable. The pattern is clear. Sophisticated capital is positioning for a major event. They are acting now. Whether it happens within the next 12 hours or the next 12 days, it is approaching. And when it arrives, you will wish you had taken action while time remained. Let me share a brief story. In February 2020, I was detecting similar patterns within market data. On the surface, everything appeared stable. The stock market was achieving record highs. Everyone was discussing economic strength, but beneath the surface, warning signs were ubiquitous. I published a video advising viewers to take some profits off the table and prepare for volatility. Many people believed I was being alarmist. Then March arrived. The market plunged 35% in a matter of weeks. Those who heeded the advice and prepared emerged intact. Those who ignored the warnings were devastated. I am experiencing that same intuition right now, that identical sense of underlying instability, even as the surface appears calm. The difference is that this time the warning signs are even more conspicuous. This time, institutional positioning is even more extreme. This time, the global economic foundation is even more fragile. If my analysis is correct, the coming event could make March 2020 appear moderate by comparison. Therefore, here is what I urge you to do immediately. First, conduct a rigorous examination of your portfolio. Be brutally honest about your holdings and whether they remain sensible given developing market conditions. Second, evaluate your exposure to assets that could be severely impacted in a risk-off environment. Third, decide what your action plan will be if markets open sharply lower tomorrow. Will you panic and sell? Will you hold firm? Will you attempt to buy the dip? You must have a predetermined strategy before the emotions of a significant down day impair your judgment. Fourth, earnestly consider adding portfolio insurance, whether through precious metals, increased cash holdings, inverse positions, or put options. Implement something that will protect you or even profit should conditions deteriorate. You do not want to be entirely exposed if this scenario unfolds as I anticipate. Before we conclude, I need you to do something for me. Please leave a comment below sharing your perspective on the next 6 to 12 hours. Are you observing the same warning signals? Have you already taken steps to protect your portfolio? What is your strategy heading into tomorrow's market open? I read every single comment and value your insights. This engagement also assists the platform's algorithm in distributing this video to more people who require this information. So take 30 seconds and post your thoughts now. If you found this analysis valuable, if you appreciate receiving this caliber of real-time market intelligence that is unavailable elsewhere, please do me a favor and share this video. Send it to family members, friends, and anyone you know with market investments who may be unaware of the potential developments. This is the type of information that can genuinely safeguard someone's financial future. Sharing it requires mere seconds. Use the share button to disseminate this widely before this window closes. Remember, here at Let Finance, our mission is not to sell you a product or promote an agenda. We simply analyze the data and report our findings. Sometimes that involves highlighting opportunities. Other times it involves issuing risk warnings. Today is a warning day. The next 6 to 12 hours are critical. The activity when Asian markets open tonight could establish the trajectory for the remainder of this month or even this quarter. Be prepared formulate a plan, and above all, do not disregard the actions of the smart money. They are positioning for a significant event. You should be too.